Good, excellent. Good to see you all. Good to see you all coming in. Excellent, excellent. So there we are. We've got London, New York, San Francisco, Georgia, Dallas. Excellent. Artem in Vienna. Excellent. Terrific. Good to see you all. Thank you so much for coming in. More people coming in. We will move on swiftly now to the subject today, why we should be investing in crypto and blockchain. And never has it been more apposite to be speaking to both Matthew and to Baker. Front page of The Economist this week. Elon Musk this morning, or was it yesterday afternoon? This is a really particularly good time to be talking on this subject. When I first spoke to Matthew, who's recently joined Forum a few months ago, he was talking to me about the work that he does, and I was completely fascinated by it, almost ready to send him a check. And but what I did think was, this is a discussion that needs to be heard by the Forum membership, and hence my request. And who better than Baker, a great friend to Forum, to be in conversation with Matthew. So we follow the normal format of a 20-minute discussion between Baker and Matthew. And at that point, we will cut in and answer the questions in the sidebar. So please put your questions there. And with no further ado, Baker, please take over for me. Thank you so much.
Thank you, Simon. It's great to finally have Matt join our organization, and I'm excited to let him express his views on crypto and his firm BlockTower. To start off, I thought, Matt, given your background and career at Goldman Sachs Asset Management, what was the catalyst for you to leave and start your own investment management company?
Yeah, it's great to be here. Good to see everyone. I don't think I've met all, well, certainly not all or even most of you, but I've met a few folks, even in the few short weeks that Simon has graciously brought me into the fold here, and I've really been enjoying it, even amidst what is a very busy, to say the least, time in my world, from basically all angles, but cryptocurrency, blockchain technology, all of that, kind of being at the forefront of a lot of what's happening right now. Yeah, my journey into this was interesting. You know, part of it, as with most things in life, was a lot of luck. So before I spent my 11 years at Goldman, I was an engineer. And in late 2012, it was that part of my brain, that engineering part of my brain, that kind of tripped and stumbled upon cryptocurrency, Bitcoin at the time. And that part of my brain got really kind of captivated by it. Unfortunately, I wasn't thinking like an investor and just saying I should buy as much of this stuff as I can. I was kind of geeking out on the technology. I was like thinking about consensus mechanisms and watching videos about proof of work mining and kind of the underlying engineering of what this technology represented. And I was very drawn to it. I mean, I've got 3 young children. I was thinking a lot in the years leading up to that about what are not only the technologies and the forces that are going to shape our world as an investment kind of world, but also that are going to shape our lives and the things that we interact with, or better yet, that my kids interact with. And this sort of just something about this was very profound and struck me, even though I didn't quite know how to kind of process that in my mind. But what that did do is it gave me sort of this, I call it like a psychological runway, where, you know, you discover the thing in 2012, you're trying to make sense of it, you're coming up the learning curve, you're talking to fellow engineers. And, you know, 1 year goes by, 3 years, 5 years, you see you're following the market and things that are being built. And then we got to, call it late 2016, early 2017, when we were clearly in a cryptocurrency bull market right now, and it's an attractive time to be getting involved, and there's a lot of stuff being built. The last cryptocurrency bull market, as many of you probably remember, was in 2017. So my co-founder and I saw that. We saw that coming towards the end of 2016, early 17, and we said, you know what? You know, we're both lucky to have been sort of marinating in this space for 5-6 years now. we're psychologically ready, right? We know it's the future. We know it's this, disruptive new technology and this important new industry and asset class that everyone's going to ultimately have as part of their portfolios. And I don't care if you're a university endowment or a pension or a sovereign or a family or an individual, this is going to become pervasive and it's going to make its way into all investors' portfolios. It's not a question of if, it's just a question of how quickly can they do it, right? The billionaire who's a principal who can just say, I'm going to take a little bit of my money and put it in this, will obviously benefit sooner and more quickly than my friend who runs the Verizon pension fund, for example. He's an ERISA fiduciary here in the US, overseeing a pension fund as an employee. He's not going to be as willing to stick his neck on the line, 4 or 5 years ago and allocate money to the space. He'll do it personally, but not for kind of the broader institution yet because of that bureaucracy, basically. So we sort of had this thesis both in, being convicted in the technology and equally as important, the nature of the investment opportunity. The birth of a new asset class doesn't come along every day. And what we saw happening was probably the most unusual and attractive investment opportunity I may ever see in my career, probably even my lifetime, right? And so in the abstract, it was that attractive. My co-founder, who was a portfolio manager at the University of Chicago for their $8 billion endowment, and I said, maybe we just set up a private investment firm and invest our own money because the investment opportunity is that attractive. But as we thought more about it, we've been students of markets. We've been investors and traders in all asset classes: public markets, private markets, equities, equity derivatives, currencies, commodities, even electricity forwards, and crypto. And so we've kind of seen what's happened to investment strategies over the years and over the decades, what's happened to alpha, how certain strategies and sectors have become very overcrowded and well understood. And crypto was kind of the opposite, right? It was nascent, it was new, it was different. This isn't just another flavor of equity. This is a fundamentally new asset. And so we looked at that and said, well, that means that the level of competition is much lower. My co-founder Ari started his career at a firm called Susquehanna International Group, which is one of the giant prop investment sort of prop firms here in the US. And they think a lot about, they're kind of poker players by DNA. They think probabilistically about the world, and they think through a risk lens first and foremost. And a lot of what we do in life comes down to table selection. Do you want to be sitting at a table where you're competing with the behemoths who have been doing it for 40 years and have built long-term sustainable advantages? It may sound seductive to say I'm launching a firm that's competing with Rentec and Citadel and Blackstone and Sequoia and Bridgewater or whoever it is, but the practical reality is not that fun, right? The practical reality is, not as sexy sounding as being able to say I'm starting an equity long short fund or a macro fund or a buyout fund or a venture fund. Whereas in crypto, those guys weren't in the game yet. I knew they would be, but I knew it would take them 5, 6, 7 years. So we looked at this and we said, wow, there's actually a window of time here. There's actually an opportunity to build an industry leading firm where that's gotten really hard to do in most traditional asset classes and markets that we're all familiar with. So that was part of, frankly, candidly, that was a big part of the catalyst for me, even as I was simultaneously welcoming my third child to the world, to pull the ripcord, to jump from Goldman with both feet and start sprinting in this space. And certainly we got very lucky along the way. I mean, we almost accidentally established this large leading brand and position in the industry. We were obviously fortunate to be joined by wonderful partners and investors, not only wealthy individuals and families, but even folks like Andreessen Horowitz and Union Square Ventures. These are top venture capital firms here in the U.S. And they joined us as LPs, as investors in our fund. So we were really lucky to sort of establish that right foundation to be able to build from and build a long-term firm and franchise. I'll stop there, but that's kind of the gist of the story.
Kind of to back up a second, and I think probably there's some viewers on this Zoom that maybe need kind of a 60-second fundamental lesson on what cryptocurrency is, what are the technologies maybe behind it, like block ledger, and then also maybe a bit of the decentralizing theme and how that will continue to be kind of portraying forward in 2021.
Yeah, good call. So the fundamental innovation here is not the blockchain. Actually, blockchain as a concept has been around for over 30 years. The company IBM has a patent on a blockchain that's 30 years old. A blockchain is just another kind of database, a better kind of database that arguably the back office of Goldman Sachs should have been using, and they shaved some of their costs down by 20 or 30%. They can better track information, eliminate errors, that sort of thing. Really, the fundamental innovation here is the advent of a native token, a native cryptocurrency, a digital asset, combined with a blockchain in a way that's never existed before. And this all started with Bitcoin coming out of the 2008 financial crisis, which most, if not all of us, lived and worked through. Coming out of 2008, Bitcoin was born into the world. I don't think that was a coincidence. Obviously, people were worried then about stimulus and bailouts and money printing, and that's only been more exacerbated, and we can get to where we are in the world now and what happened last year. So Bitcoin was born as the first truly digital asset with security and with scarcity. So digital assets as a concept have existed for a long time. I've got JPEG photos of my kids or my favorite MP3 music file, and I could send that to you, Baker. I could send you a photo of my kids, which I have done. And but there's no scarcity there. There's no verifiable ownership there. You have it, yes, but I still have it too. We both just have copies of that digital asset. What a cryptocurrency combined with a blockchain enabled is a provably verifiable, truly scarce and ownable digital asset that has built-in consensus, that eliminates the need for a centralized third party, for some intermediary or rent extractor or bank, some third party sitting in the middle who ultimately has control of the ledger or the record. That now doesn't need to exist because you have a consensus mechanism. The strongest computer that exists on the planet all agrees that if I send a photo of my kids or a Bitcoin or whatever the crypto asset is to Baker, everyone comes to consensus and agrees that I no longer own it, I no longer have it, and now Baker does. And that's a truly, truly profound thing. It's a profound thing when it comes to the idea of money and what is money. It's a profound thing when it comes to the idea of other digital assets, like I was just mentioning, JPEG photos and MP3s, but the list goes on and on and on about kinds of things that are now enabled. The internet obviously changed all of our worlds, and it enabled us to instantly, freely, and anywhere geographically send our information. But the question is, why could it not enable us to do the same kind of thing with our value, with assets that have value, digitally native to the internet, which is clearly where the world is and where the future of the world is going? And the reason is because the legacy protocols of the internet, things like HTTP, TCP/IP, FTP, SMTP, which is the protocol behind the email that we use every day, none of these things could enable ownership and value. Now, Bitcoin and these crypto network protocols, they can. So that unlocks massively important opportunities, both in terms of money, in terms of storing wealth and value, and we can talk about that more as it relates to the world and macro environment and what's happening with the dollar, the euro, the yen, fiat currencies more broadly. It also unlocks brand new business models and opportunities for the smartest people on the planet to build things. The internet is kind of an ugly place, right? I don't think the forefathers of the modern internet envisioned it to be this thing that's fully focused on monetizing eyeballs and web impressions and advertising business models. But that's really because there weren't many other good business models you could apply. And that led to some very large centralized monopolies when you think about Apple, Google, Amazon, Facebook, Microsoft, et cetera, that were very centralized. And we've seen issues around privacy and data and all that. Now with native crypto assets, crypto tokens, and these protocols, you can enable entirely new business models that aren't dependent on pure advertising and things like that. It's very exciting.
Going to the two major coins we've got right now, Bitcoin and Ethereum. I mean, we've got a market cap of almost 450 billion on Ethereum, almost $1 trillion on Bitcoin. That's quite impressive. I think the forum members probably want to know how you look at the coins or cryptocurrencies differently, or do you look at them how do you value fundamentally the coins themselves? How do you look at trading them? I mean, they're quite volatile. Today, we're down 9.6% on Bitcoin, 8.82% on Ethereum. How does BlockTower fundamentally look at these currencies?
Yeah, it's an important question because on one hand, yes, these are disruptive new technologies creating value at massive scale, even greater scale than the first wave of internet innovation, which created. There's a key difference here, which is it's a fundamental new kind of asset, right? This is not buying equity on the cap tables of private companies, which is where most of the concentrated value and kind of tech innovation was created in Silicon Valley and the first wave of the web as we know it. Here, to your point, Baker, we have these assets that have volatility, they have liquidity. It's kind of like the Holy Grail, right? You have venture profile returns and value creation in a liquid structure, right? That there's almost no better thing that should always have existed in the world, but there's a lot underneath it, right? It's not as simple as just saying, oh, well, I'm just going to invest in this or that, because the reality is we don't fully know who the winners are going to be. So I like to think about the space by breaking it down into kind of almost like sectors, how you think about sectors in the equity market. And depending on the sector you're thinking about or the use case that you're thinking about, it kind of these things as well. Part of the reason this is an exciting space is because it is nascent on every angle. It's like kind of pre-Benjamin Graham, right? For any of you who are students of investing, it's like pre-PE ratio. And we're thinking about these fundamental valuation methodologies day in and day out and how to apply them to this novel new kind of asset in these networks. The short kind of overview is in one use case, in one sector, you have kind of the money use case, the digital store of value, digital gold use case. And that's where Bitcoin sits. We're risk managers at heart. There's risks to everything. There's a chance Bitcoin could be MySpace and some other cryptocurrency could become Facebook. But I think that risk has gotten very small. 5 years ago when we launched, I would say Bitcoin was maybe 60 or 70% to be the winner in that use case. Now I think it's over 90% that Bitcoin is going to be the winner in that digital gold, digital store of value use case. And the way you think about value for that is almost like a commodity, right? It's like supply demand. What's the addressable market? So the market cap of gold is $10 trillion. The market cap of Bitcoin, as you just mentioned, is around 1 trillion. So it's already gone pretty far in eating a good chunk of gold as a market. And it looks like it's going to continue unabated. It's going to continue to eat gold. It is a harder, faster, smarter gold in every sense of the word. Gold is a dumb rock that's been around for a couple thousand years, but doesn't, bring any of the benefits that you'd expect a modern store of value in a digital age to have, which Bitcoin brings. So if you think the addressable market is gold, or you can extend beyond that, because oftentimes what we see with disruptive new technologies is they actually expand the addressable market. So I like to think about the addressable market for something like Bitcoin as, yes, there's gold. There's also the offshore banking system. People spend a lot of time, money, energy, and friction protecting their assets in things like the Swiss banking system, the offshore banking system, Cayman accounts, et cetera. Bitcoin provides that same service an order of magnitude better and cheaper and with more accessibility, right? Because rather than only having things like Swiss bank accounts available to the wealthy, now if you're a farmer in rural India who just had his wealth confiscated through demonetization, you can secure and protect your wealth in something like Bitcoin because someone in rural India can have a Swiss bank on their smartphone in their pocket. So that's Bitcoin. And then you get into Ethereum and other use cases that are building much more technologically complex systems, things like decentralized finance applications, much more programmability and complex applications that people are going to use for different purposes. These applications, these crypto assets and protocols, you can value and think of in different ways, some of them almost equity-like. So I'll give one more example, then we can go to the next question. But like some of these crypto networks, for example, they will burn, they'll literally destroy a percentage of the coins, of the tokens that exist over time, over some set schedule. that you can kind of think about and model almost analogous to a share buyback in the world that we're all familiar with from a valuation perspective. Same with some of the networks will give out rewards. They'll actually give tokens to early users, stakers, adopters of the network that you can model and think about similar to a dividend in the world of equities and public companies and so forth. So all of these fundamental valuation methodologies are emerging. The reality with how to make money and how to manage risk is that's one input, but there are a lot of others that matter to navigate this market. It's understanding the tech, who are the winners going to be, where is value going to accrue, what's the market psychology, almost like behavioral finance in the market, who's buying, who's selling, what themes are in favor or are underpriced or underappreciated, and overlay all of that with a heavy emphasis on risk, because it's a very fast moving space where, we might be in 1996, where you might be right that internet search is going to be a massive, valuable, important thing. And you might even make a bet based on that thesis, and you could be right, but maybe you made your bets on Excite.com and AltaVista and Ask Jeeves, and you were right, but the winner ended up being this thing called Yahoo and then this thing called Google, right? And so you missed the winner. That to me is intolerable, right? My responsibility.
So diversify.
So
Dex, I know that the clock's ticking quickly. The news today in the U.S. was the Colonial Pipeline. Obviously, it's been shut down for the last week on May 7th. It was announced by the CEO this morning that he paid the hackers in Bitcoin to get the fossil fuels moving again. Can we talk about potentially the regulations quickly, and then I'll let Simon open the questions on the regulations coming to this sector due to the AML or anti-money laundering issues, the black markets that might be involved, and how maybe New York State or the U.S. regulations help clean up the sector a bit?
Yeah, regulation's been massively de-risked. That was a big risk I thought about 5 years ago when we were getting started. From both angles, a risk and something we could benefit from if and when, whichever direction it ended up going. Now you've got Bitcoin and cryptocurrency and the proponents of this technology at every layer of government. I'll speak about here in the US first, but the same is true or for most major economies and governments around the world. You've got Gensler for the last 3 years before he assumed office. He was teaching a course on Bitcoin and blockchain at MIT. You have the head of the CFTC. The former head of the CFTC is on our board. He launched Bitcoin futures, and now he's launching a US central bank digital currency, the digital dollar. The new head of the CFTC is a Bitcoin supporter. You have senators who are, will fight to the grave for Bitcoin. Cynthia Loomis is a senator out of the state of Wyoming who is a public owner and advocate of Bitcoin. You have state level regulations in places like Wyoming, Texas, Florida, and many other states adopting this. You have people holding it on their municipal balance sheets, paying their employees in it, allowing people to pay taxes in it. So, and by the way, I think if a hacker hacks a pipeline, or like last year, I think someone hacked Twitter and like commandeered the accounts of like Bill Gates and a few other large names on Twitter. The fact that hackers want to be paid in Bitcoin just means it's just proving the concept, right? It just proves that it's the most desirable asset on the planet. They're saying we don't want US dollars, we want Bitcoin, right? And up until now, everyone who hacked something demanded dollars, right? So I think the value of the asset, whether you're an individual, an investor, an institution, a sovereign, a public company, a private company, an insurance company, general account, that tipping point has flipped, right? And last year, people truly internalized what was happening in the world and how they needed to protect themselves against it. And owning Bitcoin, and by extension, many other crypto assets, is kind of the action that came out of it. But regulation's headed in the right direction. We speak with regulators constantly and understand how they're thinking about it. And it's very constructive because they know there's a lot at stake, right? The next wave of innovation, if the government and US regulators want that wave of innovation to happen, or at least meaningfully happen within the US, like the .com boom did, they know they can't be draconian and can't stamp out an important new technology, because if they do, some other country, be it China or elsewhere, will embrace it and is embracing it wholeheartedly, and will, there's kind of leapfrog risk there from a kind of national perspective.
I'll let Simon know. Do you want to open the floor, Simon? Because I know we're
Yeah,
We're getting
thanks,
short on
Beck.
time.
Yeah, thanks, Becca. Thanks, Matthew. And delighted to run on beyond the half hour if people would like to stay on. We've got a lot of questions coming in. I know I've got a couple of questions, but I'm going to go actually straight to Zandra. Zandra, there you are in LA, and you gave us a great talk last week, I think it was. So will you come in and ask your question of Matthew, please?
Yes. We know Elon Musk has been weighing in heavily on this, and he is a thought leader, so to speak. Some people will consider him that. He moves the market on crypto. I mean, let's be frank on that. So he's really concerned with the energy footprint it takes with the blockchain technology to mine Bitcoin, for example. So now he just made an announcement on Twitter that he wants to look for a cryptocurrency to accept for Tesla purchases that is less than 1% of Bitcoin's energy byte. Do you think this might be something that large corporations, governments, everyone will be taking into account as well?
Yeah, so the energy question is common. Elon is a character, as we all know. He says certain things one week, different things the next week. The reality is people talk with their actions, and the actions Elon has taken is owning over $1 billion of Bitcoin on Tesla's balance sheet. And he's not the only one. There's a lot of companies that I've talked to that I can't name because it's not public. There's a lot of public entities and public companies. If you go to the website bitcointreasuries.org, bitcointreasuries.org, it has a running list of all of the public companies and all of the public entities that own Bitcoin on their balance sheets. And it is a rapidly growing list. Now, some of them, granted, are crypto companies. Like a friend of ours is Mike Novogratz. He has a company called Galaxy. They own it. That's not a surprise because they're a crypto company. But the MicroStrategies, the Teslas, the Squares, the list is growing of companies who are adopting this. Mass Mutual, which is a 169-year-old life insurance company here in the US, bought $100 million of the stuff. The energy question is an important one, and it's one where there's a lot of misinformation. So people will look at energy usage and they'll say, well, if you compare it to Visa, the credit card network, Visa, Bitcoin consumes a lot of energy. But the reality is, A, that's not true, and B, that's not the right comparison. If you're going to make an apples to apples comparison, the comparison isn't to Visa. The comparison is to, okay, you're building an entirely new parallel financial system that consumes some energy, and we can talk about next how it does that. And then let's compare that to the existing legacy financial system and all the people, buildings, computers, light bulbs, real estate, locations, offices, infrastructure, IT, everything that's in that system. And if you make that comparison, it's kind of a non-comparison. The other really important thing, and there's a friend of mine named Nick Carter, maybe we can circulate some links, Simon, after the talk, because I know we're limited on time, but there's been some very eloquently written, what I think very educational articles and essays about this topic. One of the other thing that's important, and the World Economic Forum and others have talked about, is that Bitcoin mining, for example, actually propels the usage of clean energy, of renewables. So why is that? Well, a lot of the best places to generate clean energy, whether it's hydro or wind or solar, it happens in places that are pretty far off the grid. It's not happening right next to, where I spent 12 years in the middle of New York City. It's happening out in very desolate places. And storage and transmission of energy is a big problem. Well, Bitcoin kind of solves that. It brings the most powerful supercomputer on the planet to the entire world, and it doesn't have it's decentralized, so there's no specific hub or locale where it needs to be located. So what does that mean? That means you can go to Siberia. That means you can go to the middle of Texas. That means you can go to these places where you can generate and catalyze the use of renewables and not have stranded energy. And you can put a Bitcoin mining rig right next to that to make use of that energy. So there's actually been some real work done around how this is catalyzing the growth of renewables in the world, which I think is really important to understand as well. And then the last piece that I'll mention is not all cryptocurrencies use proof of work mining, which is specifically what this discussion centers around. That's what Bitcoin uses. Ethereum is in the process of moving to something called proof of stake. And in fact, many of the next generation blockchains that are competing, not necessarily with Bitcoin, but with these other kind of web application, decentralized finance, NFT areas, a lot of these use other consensus mechanisms that do not include or involve mining. And things like proof of stake, for example, as a consensus mechanism, does not have that same energy intensity. So there's a lot of smart people working at a breakneck pace, innovating at a mind-blowing pace, developing new consensus algorithms that are different from different angles, one of them being energy consumption. So it's an important topic and one that people should really, understand more fully.
So Michael, can I just bring you in there? So Michael Meehan here, forum member and a long-term leader in impact and sustainable investment. What's your what would be the issue or the answer that you would put to, or the question that you would put to Matthew?
Well, Matthew sort of answered some of it, right? Which, but you've got 40 trillion globally in institutional investment, some of which dabbles in crypto, but much of it doesn't, for a whole lot of reasons. But one of the reasons is the energy question, and I feel the industry hasn't really provided a good answer. Now, we all know that energy comes from a lot of different sources, and so it's really where we're pulling our energy from, not really Bitcoin. But when you've got one market that's pulling 0.6 of the world's energy consumption, the institutional investment world wants to see an answer, and we don't really see an answer from the crypto world. And Matthew, can you give any sense of, are there organizations out there that are trying to provide that answer to the institutional investment world so we can more readily participate in this?
Yeah. I mean, it's a great point, Michael. I think the answer's there. It's just a question of, is XYZ institution in a position where they're truly understanding the issue, or are they reading the media headlines? Yeah. And the reality, to your point, is there's a ton of capital, there's a ton of institutions. They don't all have access to talk to experts, right? Or talk to people who can demystify and clarify what's actually going on. Some of them have, right? And there's a lot of institutions. I could name a list of 30 institutions. 17 of the top 20 university endowments here in the US have exposure. Insurance companies, public companies, I know a few pensions. Like, this is the world I came from, and I almost deliberately ignored them for a while because I knew they would invest, but I knew it would take them 4 or 5 years to get through the bureaucracy and the decision making. But now that psychology has changed, some of them have the energy question, and they just need a trusted source, basically, to demystify it to the extent it's an issue for them. So I think there are people out there who are having this conversation. I think you just probably have, amidst the media noise and misinformation and the quantity of credible people who can speak to this versus the overwhelming list of institutions who are desperate to learn and figure this out, you just don't have enough bandwidth to hit them all at once, kind of thing. And people like us and friends of ours in the industry do our best, but we can't be everywhere at all times. Which is why I'm a big fan of these kind of venues where it's one to many, and you can like I did a lap about 3 weeks ago with all of my friends from my former life in Goldman, who are CIOs of big pensions, endowments, insurance companies, Canadian pensions, sovereigns, Dutch pensions, et cetera. And it's clear that people feel a sense of urgency about this, but they also still don't feel like they fully have that level private roundtable to talk about crypto. And within 4 hours of sending that out, we had 30 CIOs from all of these institutions saying, yes, we need to figure out our crypto strategy. We have questions like this. So that kind of stuff, we need to have more of it, right? There needs to be more voices, or you need to have more access to people who can help provide that guidance. The energy issue is a bit misplaced, and happy to talk more about that, share some of the writing about that as a follow-up to this. But yeah, I view that as one of our core responsibilities. Obviously, first and foremost, to deliver to our LPs this kind of generational opportunity and make sure we capture, to educate, to inform, and to help kind of the industry build in a responsible way and institutionalize. And it has, by leaps and bounds since we launched 4 years ago. Now you have all the institutional infrastructure, you have institutional investors, you have tools and systems and exchanges and custody and prime brokerage and futures and options and everything that our robust financial market can and should have. But these are always questions that you can't answer enough times, for sure.
Yeah, for sure. Great. Thanks, Matt.
So Matthew, can I come in with a question here and just bring you back to your statement about Bitcoin being almost certainly a 90% winner. So we read in The Economist this week that JP Morgan's created its own digital coin and is setting up a Bitcoin fund. So just for the uninitiated like myself, if Bitcoin is such a certain winner, why is JP Morgan creating its own digital coin?
There's a lot of applications for crypto. So Bitcoin, I think, is very likely, like I mentioned, to be that ultimate winner as a digital store of value, digital gold. The most important thing that matters there is security. Like, you want an asset that can't be seized, can't be taken from you, can't be depreciated, devalued, or debased by a central banker or a politician. And you're seeing this to devastating effect in the US, right? Jerome Powell's expanding the monetary supply at 15 to 20% a year for the next who knows how long. If you leave your money in the dollar, if you're in cash, you're going to lose half your money over the next 5 years. The same is true with other of the major fiat currencies, the euro, the yen. It's even worse and more pronounced in other economies where it's devastating, right? You look at Lebanon, you look at Venezuela, Argentina. There's like 70% of the world are facing a crisis where people need this to exist. The reality is the best cryptocurrency that provides this is the one with the most security, and Bitcoin has the most security. It's got the most amount of monetary energy on the network. It's $1 trillion in market cap. It's kind of crossed the chasm, right? 4 years ago, I would have said probably Bitcoin, but maybe another cryptocurrency. That was when Bitcoin was, 50 million in market cap, 100 million in market cap. Now it's over $1 trillion. Now you have institutions, public companies, balance sheets, sovereigns, you name it, allocating. Like, they're not trading it, right? They're not putting money in because they're going to sell it in a month or a quarter or a year. They're making long-term, they're going to hold it forever. And that's the kind of, like, any tech network that is network effect driven, once you reach a certain threshold, it becomes unstoppable, right? If you look at mobile, Apple did that with the mobile wave and iOS. If you look at social, Facebook did that with the social network. And once they cross, $100 million in market cap, they've achieved that network effect, and there's not going to be a competing network that can usurp it. Same thing with e-commerce and Amazon, or search and Google. Like, all these examples permeate everywhere. Now we're talking about it as it relates to the world's first ever digital monetary network, and that monetary energy is there. So that's why I say it's 90-95%. Other cryptocurrencies will be created for different use cases. So Bitcoin might be the most secure and stable if you want to store your wealth, let alone grow it or protect it from devaluation and debasement of fiat currencies. That's the first place people can and should go. But other use cases, like certain applications, decentralized finance, other things that are more feature rich and programmable, that's where things are being built in Ethereum. JP Morgan, Facebook, they're trying to launch their own coins. Many of these are what's known as stable coins. So a lot of people thought Bitcoin was going to be used to buy coffee at Starbucks. The reality is no one wants to buy coffee with their Bitcoin. No one wants to spend their Bitcoin. It's not a transactional payment rail. It's a store of value, and it's the hardest of hard assets. It's the best one that's ever existed in the history of planet Earth. So, but cryptocurrency as a technology is very useful for things like a better payment rail, a better way to facilitate transactions, a better way to buy things, a better way to do remittances and cross-border payments and things like that, because our financial infrastructure, I mean, you look at the SWIFT system, you look at the FedWire system here in the US, you look at the fact that it still takes 3 days to settle a stock trade and all the fees and stuff that are embedded in these archaic banking services and products, it's all pretty outdated, right? The internet revolutionized everything we do. Why didn't it do that to our money? Well, now that's happening. And part of the way that's happening is things like, sometimes it's a closed ecosystem, like a walled garden of a JP Morgan coin, where they're going to facilitate maybe transactions between them and another group of banks to facilitate certain trades or transaction activity. Central banks around the world are all launching central bank digital currencies. I mentioned our board member, Chris Giancarlo, who's launching the digital dollar. The digital yuan has already been launched. We're behind on that. The US is behind China. The digital yuan is already in the hands of citizens in China, already integrated into their WeChat and other kind of wallets on their mobile phones, and being tested and utilized in pilot programs. Because at every layer of government, it makes sense to have a crypto version of your fiat sovereign currency. Like, if you have a crypto dollar, every layer of government can do their job more effectively. The Fed can more effectively take in economic data and target interest rates. The IRS can more effectively track transactions and collect tax revenue. The FBI can more effectively track, where money's moving and crack down on criminals, right? You can't really do that when money's moving around in green paper bills in briefcases crossing the border from Mexico to the US. You can do it if everything's in a transparent ledger where all transactions can be seen. So a lot of these coins that you're seeing launch, Simon, are things like these stable coins that are going to facilitate certain kinds of transactions that are parallel to Bitcoin. They're not competitive, they're parallel.
No, thank you for that. It's almost like Bitcoin's a misnomer now. So I understand that.
There's a lot of confusion. Yeah.
Yeah, I get it. So thank you so much. We had a lot of time, but I just want one more sneaky question to Baker. So Baker, there you sit as I know you're not an old school investor, and I know you're out there and you're looking for new territory. What's other than talking to Matthew, what's your policy on investing in Bitcoin and crypto?
I've always been a believer, if I fully don't understand something, to hire the best, and I think that's where people like Matt are useful and needed in the investor landscape. And I think the question I would ask him is, since there's a lot of investors on the call, what is the appropriate allocation to Bitcoin or Ethereum or to crypto for an investor like me or Simon or other members on the call?
Yeah, I mean, now being part of the Forum family, I mean, everyone should consider me an ally, a friend, a resource, regardless of whether or not there's anything to do with BlockTower or whatever. Like, I am happy to help point people in the right direction as how the different ways to think about getting out and think of, because I've been LPs and hundreds of fund managers. How can you approach investing? What are the different ways you can get access, whether it's investing in a fund or opening a wallet yourself or whatever it is? The allocation question, Baker, is a good one. And the answer is not zero. Like 100% it's not zero. It's also probably not 50%, right? If you ran a portfolio theory optimization and you said, here's an asset that's relatively uncorrelated. I say relatively, right? A lot of people are very pie in the sky and they're like, it's uncorrelated. But the reality is things may be uncorrelated. When it matters most, things aren't uncorrelated, right? We saw that in 2008. We saw that in March of last year. But it is relatively uncorrelated. And more importantly, is it has risks, but those risks are different than the other risks in an investor's portfolio. So they may have different risks like beta or duration or illiquidity risk with a private deal or a venture capital investment. With crypto, you've got other risks, but because those risks are idiosyncratic, it's actually additive to the overall portfolio, meaning it's the kind of asset that could simultaneously reduce your expected risk while increasing your expected return at the portfolio level. So what does that mean in practice? I've seen everything across the board. I've seen individuals and wealthy people and families basically say, I see the future, the world's going to be denominated in Bitcoin and cryptocurrency. Fiat currencies, the dollar, the euro, the yen, they're dead. Like this is like literally they're past the point of a slippery slope. What central bankers are doing is destroying that system as we know it, which a lot of people think has been around forever. It hasn't. It's not even, over the course of human history, the concept of fiat nationally owned currencies is not even that old. It's just something we're all used to because it's been our lifetime, basically. But I've seen people completely adopt crypto and denominate their entire lives in it. I don't think you should do that. I don't even think if a portfolio theory optimizer told you, man, this is an uncorrelated asset with a high expected value and idiosyncratic risks, you should have 40% or 30%. I don't think you should necessarily do that. What I'm seeing the most, and individuals may have more risk tolerance on this, but institutions, for example, 5 years ago it was educate me. 3 years ago it was 1% to 2%. Now I'm seeing that tick up between kind of 5 and 10% sort of allocation. And then individuals and people who have more of a principal standing than being kind of an agent for a broader institution. I've seen plenty of people in the 10 to 20% range. Personally, I'm probably somewhere in that range. When I started the firm, I was irresponsibly exposed. I had basically all my net worth in the fund, which was not a big number, but it's basically everything I had. And I was you think about risk and you think about diversification benefit, something in the 10 to 20% range, probably closer to 10% range is where I'd personally put myself.
So thank you both very much. We really have gone over time here. Very fascinating. Thanks, Baker, so much. There is a recording of this, as there always is, and that will be put on the forum app. There was so much content there. I rather suspect quite a few of us will want to go to the recording. Questions? Thank you, Matthew. Those of you who would like to put further questions to Matthew, just be in touch with me or connect with Matthew directly on the app, but whichever way you choose. And also, I'm glad to say that we'll see both Baker and Matthew again in a month or so's time, June the 1st, when Matthew will be asking Baker the questions. So we look forward to that very much. And I think that's it. Thank you so much to both of you. Really appreciate it. And have a good day to everybody. Thank you so much for tuning in, everyone. And we'll see you very soon. Thank you and goodbye. Goodbye.
Thanks, everyone. Cheers.
Bye-bye. Bye-bye.